in the computation of accounting profit, but the company has agreed with the tax authority that that expense will only be treated as allowable expense. Will only be treated as allowable expense in the year 2026. So what does that mean? It basically means that this particular expense will only be recognized as allowable expense not in 2024, not in 2025, but in 2026. When the company is computing the taxable profit for 2026, that's when the expense will be treated as allowable expense. It means that when the company was computing the taxable profits of 2024, that expense was not recognized as allowable expense. But you can see when the company was computing the accounting profit for 2024, it was recognized as allowable what? Expense. So that difference which will occur between the accounting profit in 2024 and also in 2026, we refer to it as the timing difference. And actually, this is the difference which result or which give rise to deferred taxes. So this one we say the permanent difference. This one does not give rise to the timing what? Differences. Now, therefore, what is important here for you to be able to remember is that the deferred tax, this one arises because there is a difference between. Yes, so I want us to start on this topic here, IS 12, deferred tax, or basically deferred taxes. And first of all, if you can be able to recall what you covered in financial reporting and analysis, you did this. Yes, so I want us to start on this topic here, IS 12, deferred tax, or basically deferred taxes. And first of all, if you can be able to recall what you covered in financial reporting and analysis, you did this topic, the topic on income taxes. And maybe just a quick recap on what you covered in financial reporting and analysis. One, you are told an income tax basically is the tax which is payable by the company to the government based on the reported profit. Generally, what we know is that once a company has been registered with the Registrar of Companies, that company is recognized as a legal entity. And therefore, this company has to pay tax to the government just the way you pay taxes to what? To the government. So that tax which a company has to pay to the government, this tax is called the income tax expense. And we are saying that this particular income tax expense, this one is computed based on what? Based on the reported profit, based on the reported profit of the company. In other terms, the tax which a company pays to the government is always based on the profit. Is always based on the profit which is reported by the company, based on the profit reported by the company. Equally, in financial reporting and analysis, you covered, or you are told that there are two types of income taxes, two types of income taxes, or yes, two types of income taxes. One, we have the current tax, and then number two, we have something called the deferred tax. So these are the two types of taxes, the two types of income taxes, which you covered in financial reporting and analysis. First of all, the current tax, this one we say is the actual tax payable, in a certain financial year. So that actual amount of tax which a company should pay to the government, we refer to it as what? We refer to it as the current tax. How do we compute this particular current tax? Now, the current tax, this one is computed by taking the taxable profit, times the tax rate, and automatically from also what you have covered in taxation in PFT, you know how to compute the taxable profit. How do we compute the taxable profit? We take the taxable incomes of the company minus the allowable or the deductible expenses. Whatever you get is the taxable profit. We take that taxable profit, we basically multiply that with the tax rate. Now that will give us the actual amount of tax which a company should pay to the government. So therefore, in this case, we have said that the current tax, this refers now to that actual amount of tax to be paid by a company to the government in a certain financial year. This one is computed by taking the current tax, by taking the taxable profit times the taxable profit times what? The tax rate. Now, at this level, that is not our interest. Our interest at this level is basically how to account and also how to compute and also to account for the deferred what? Taxes. But you'll be able to see that most of the questions which we will come across at this level, they have the aspects of group accounts. For example, issues to do with unengaged profit, of which all these are aspects or these are concepts which you covered in the topic of what? Of group account. Whatever you can't be able to remember, basically will be able to remind you so that you can be able to understand how we handle those particular questions. So therefore, our main interest at this level is basically not the aspect of the current tax, but our main level here is the aspect of what? Of the deferred tax. So maybe we can start by defining what is a deferred tax. We can start by defining the deferred tax. And basically a deferred tax, from the name suggests here, to defer. Basically to defer is to postpone something and maybe do it in the future. So therefore, a deferred tax is a tax which the company was supposed to pay during the current year, but that tax has been postponed. It will be paid in the future. Or it's a tax the company was supposed to recover during the current financial year, but that tax has been deferred. It will be refunded to the company in the future. It will be refunded to the company in the future. Because in this case, it is also important for you to recall that we have two types of deferred tax. One, we have a deferred tax liability, and then we also have the deferred tax what? Asset. Now, a deferred tax liability, this is the tax which is payable in the future. Tax payable. These are tax which is payable in what? In the future. A tax payable in the future. Tax payable in the future referred to it as what? The deferred tax liability. On the other hand, when we talk about a deferred tax asset, this is a tax which is recoverable in the future. It is a tax recoverable in what? In the future. So therefore, this is something you need to recall from whatever you did in financial reporting and analysis. So why do we have a deferred tax? Why do we have a deferred tax? So basically, why do we have a tax which was supposed to be paid during the current year? It has been postponed, it has been deferred, and it will be paid in the future. Or we have a tax which was supposed to be recovered during the current year. It has been postponed, it will be recovered in the future. Now, deferred tax arises. Deferred tax arises as a result of the difference. As a result of the difference between what? Between the accounting profit, and in this case, when we talk about the accounting profit, this in other terms, we also refer to it as the profit before tax. The profit before tax is also known as the accounting what? Profit. So this one arises as a result of the difference between accounting profit and the taxable profit. The taxable profit. This is the tax you compute in taxation. To compute the tax in taxation, we take the taxable incomes minus the deductible or allowable expenses. But in accounting or in financial accounting, when computing accounting profit, we take all incomes of the company, whether they are taxable or not, all incomes minus all expenses, whether they are allowable or not allowable expenses. So that profit which we compute in financial accounting is accounting profit. That profit which we compute in taxation using the tax laws is called the taxable profit. So therefore, if these two taxes, not taxes rather, if these two profits are different, that will give rise now to something called a deferred tax. Now, let me give a small example so that you can be able to understand. So let's assume that you're given information of a certain company for the year 2024. And here we are told the accounting profit, or basically you can assume that the accounting profit of this company, remember we have said accounting profit is the same with the profit before tax. So we assume the accounting profit for this year maybe was something like 20 million or 20 million. That is the accounting profit. And then on the other hand, we are told the taxable profit the taxable profit of the company during this year, taxable profit maybe or something like 15 million. 15 million. First of all, you can see the accounting profit and taxable profit are different. And then in this case, we also assume that the tax rate applicable to this company, the tax rate applicable to this company during this year is what? 30%. 30%. And then what are we required to do here? We are required to determine the amount of deferred tax. We are required to determine the amount of deferred tax. First of all, we are saying a deferred tax arises as a result of the difference between accounting profit and taxable profit. In our case, you can see these two profits are what? Are different. So the first thing we need to do here for us to be able to compute the deferred tax is basically to compute the tax the company was supposed to pay during this year. So the tax which was supposed to be paid, the tax the company was supposed to pay. Remember from our definition, we have said a tax to be paid by the company should be based on the profit. The tax to be paid should be based on what? On the profit. And in this case, if, for example, I ask you what is the, or from these two profits, if I ask you how much was the profit reported by this company, which profit should you give me? Should you give me the accounting profit or taxable profit? From an accountant point of view, how much profit was reported by this company? From an accountant point of view, because when we talk about the profit, we are talking of that profit which we determine by preparing the financial statement. So once you prepare the financial statement as an accountant, which profit do you get? You automatically get the accounting profit. So therefore, in this case, we are saying the tax to be paid should be based on the account. It should be based on the profit. Should be based on the profit. So therefore, in this case, we can say in 2024, our company was supposed to pay a tax equal to 30%, the tax rate, times the profit. Times the profit. In this case, I've said that the profit generally, or when talk about the profit of the company, we are referring to each profit, the accounting profit, that profit which we compute by preparing the income statement. So therefore, in this case, the tax the company was supposed to pay was 30% or 20 million. So this will give us what? That will give us 6 million. But let me ask, is this the actual tax which was paid? Is this the actual amount of tax which was paid? Is this the actual tax which was paid? Automatically, no, because in this case, we have said the actual tax to be paid by the company, the actual tax to be paid by the company, this is something we know, you know from PFT, you know from tax, the actual tax to be paid should always be based on the taxable profit. So meaning that during this year, the company was supposed to pay a tax of 6 million, but because the accounting profit and taxable profit are different, then the actual tax to be paid will be equal to 30% of the taxable profit. How much is our taxable profit? 15 million. So this will give us 4.5. It will give us 4.5. Our company was supposed to pay a tax of 6 million, but because the accounting profit, taxable profit are different, our company ended up paying a tax of what? 4.5. So you can see in this case, our company paid less tax than it was supposed to pay. So how much, or basically what is the difference between these two values here? So the rest tax which was paid by our company will be 6 million minus 4.5, which is basically 1.5. 1.5. Now this 1.5, this one we refer to this as the deferred tax. We refer to this as what? As the deferred tax. We have said our company was supposed to pay a tax of 6 million, but because the accounting profit and taxable profit are different, our company will pay an actual tax of how much? 4.5. So the rest tax which has been paid, which is 1.5, this tax automatically will be paid in the future. So being a tax to be paid in the future, this one we refer to it as a deferred tax what? Liability. We refer to that as a deferred tax what? Liability. Remember, you have said a deferred tax liability is a tax the company was supposed to pay during the current year. That tax has been deferred, or has been postponed. It will be paid in the future. Also, remember, you have said that the reason why we have the deferred tax, or this deferred tax arises, is because the accounting profit and taxable profit are different. But if these two profits were different, the accounting profit and taxable profit were the same, then in such a case, we don't have what? We don't have the deferred tax. So therefore, you can see that this deferred tax purely arises because of the difference between accounting profit and what? The taxable profit. Now, this difference between these two profits is broadly classified into two. So we can say that the difference, between the accounting profit, because we are saying the accounting profit and the taxable profit, these two profits may be different. And basically, we are saying that that difference is the one which gives rise to what? To the deferred tax. So this difference may be broadly classified into two. We have something called the permanent difference. This is also something you covered in financial reporting and analysis, permanent difference. And number two, we have something called the timing difference. The timing difference. What is the definition of each of these difference? Or what causes each of these difference? Now, the permanent difference, basically we say that this is the difference between these two profit, accounting profit and taxable profit. The difference between accounting and taxable profit, which arises because there are some items of incomes or expenses which were used in the computation of the accounting profit, but those items were not used in the computation of taxable profit. Let me repeat that. I've said that the permanent difference, this is a particular difference which arises automatically, the difference between accounting profit and taxable profit, which arises because we have those items of incomes or expenses which were used in the computation of this profit, but those items were not used in the computation of taxable profit. Automatically, for you to be able to understand this, you have to recall what you covered in taxation. In taxation, we know there are those particular expenses which we use in computation of accounting profit, but we don't use them in computation of taxable what? Profit. And which name do we give to those expenses? You can be able to recall those expenses you use in computation of accounting profit, but those expenses are not used here in computation of taxable profit. You can be able to remember the name given to that in PFT, in taxation. In taxation, the name given to that is which one? The name given to that. Yes, I'm told by Kennedy they are called disallowable expenses. Is that correct? Are they called disallowable expenses? Those expenses which you use in computing the accounting profit, but you don't use them in computation of taxable profit. Automatically, we refer to them as the disallowable expenses. The disallowable expenses. Can you give me a good example of a disallowable expense? Give me a good example of a disallowable expense. A disallowable expense. Yes, I'm giving a very good example here. Depreciation. Depreciation is a disallowable expense. Depreciation, we use it in computation of this, but we don't use it in computation of, we don't use it in the computation of taxable profit. Another good example, purchase of an asset. There is no way we use that one. Purchase of an asset is not an expense. Austin, this one is not an expense. Another good example is something like medium is saying administrative. Administrative, generally, those ones are used here. They are also allowable. Another good example is something like fees and fines, or maybe fines. That is fines and penalties. Fines and penalties. If, for example, you have a business, you are penalized, you are fined because you didn't pay, or maybe you didn't file the tax return on time. Maybe when computing the accounting profit, you use that as an expense. You recognize that as an expense. But in taxation, penalties and fines are not allowable expenses. Another good example is something like amortization of intangible assets. We recognize it as an expense, but is amortization allowable expense? Automatically no. So therefore, we are saying that this particular permanent difference is occasioned by those items. Those items which you use in computation of accounting profit, but we don't use them in the computation of taxable profit. They give rise to something called a permanent what? A permanent difference. Now, timing difference, on the other hand, is still the difference between these two profits. And what causes that difference, timing difference? It is a difference which occurs between these two profits as a result of taking into account similar items, or as a result of taking into account certain items of incomes and expenses in the computation of two profits, but in different accounting periods or in different years. Let me give an example. Assuming we have an expense which has been incurred by the company, maybe in the year 2024, you can be told that this particular expense was used in the computation of accounting profit in that year, in the year it was incurred. In 2024, it was used in the computation of accounting profit, but the company has agreed with the tax authority that that expense will only be treated as allowable expense in the year 2026. So what does that mean? It basically means that this particular expense will only be recognized as allowable expense, not in 2024, not in 2025, but in 2026. When the company is computing the taxable profit for 2026, that's when the expense will be treated as allowable expense. It means that when the company was computing the taxable profit of 2024, that expense was not recognized as allowable expense. But you can see when the company was computing the accounting profit for 2024, it was recognized as allowable what? Expense. So that difference which will occur between the accounting profit in 2024 and also in 2026, we refer to it as the timing difference. And actually, this is the difference which result or which give rise to deferred taxes. So this one we say the permanent difference. This one does not give rise to the timing what? Differences. Now, therefore, what is important here for you to be able to remember is that the deferred tax, this one arises because there is a difference between the accounting profit and the taxable profit. We are saying that that difference between the accounting profit and taxable profit can either be permanent difference or can either be timing what? Difference. Now, next, before we look on how we compute this particular deferred taxes, and basically the different methods which are used in the computation of the different method used in the computation of deferred taxes. First of all, I want us we define some few terms. We look on definition of terms. Definition of terms. These are basically some terms we will come across in computation of deferred tax. So someone is asking about the timing difference. Timing difference, I've said, is the difference which gives rise to deferred taxes. And actually, I've said that difference, timing difference, is the difference between accounting profit and taxable profit, which occurs because we have certain items of incomes and expenses used in the computation of two profit, but in different accounting periods. You have incurred an expense in the year 2024 as a company. You use that in the computation of accounting profit in the year 2024, but you will only use it in the computation of taxable profit, maybe in the year 2026. The accounting profit and taxable profit will be different in 2024, and also in 2026, the two profits will be what? Will be different. That difference, we refer to it as the timing difference, and you have said that that is the difference which gives rise to the deferred tax. So here we have a few terms we need to define. The first term is something called the carrying amount. Carrying amount, basically abbreviated as CA. So carrying amount, this is the value of an asset or liability in the statement of financial position. In other terms, this is the value at which an asset or a liability is recorded in the statement of financial position. So we say that this is the value of an asset or even a liability in the statement of a financial position. In other terms, this is the assets or liability book value, or maybe the net book value. That value at which an asset or liability is recorded in the statement of financial position, it is what? The carrying amount. For example, something like all assets such as PPE, property, plant, and equipment, their carrying amount is always equal to the net book value, which is equal to the cost minus the accumulated what? Depreciation. So the other term we also need to define here is the tax base. Tax base, abbreviated as what? TB. TB tax base. This is what? This is the value of an asset or liability for tax purpose. Value of assets. Value of assets, or basically liability for a tax purpose. For tax purpose. For example, in taxation, do we talk of the net book value of assets? In taxation, specifically whenever you're computing capital allowances, we don't talk of the net book value of the asset, but we talk of something called what? The written down value. The written down value of an asset. The written down value of an asset, this one is equal to the cost minus the accumulated capital allowances. Minus the accumulated capital allowances. Because in taxation equally, we don't have depreciation. In taxation, we have what? Capital allowances. So therefore, tax base is the value of an asset or liability for tax purpose. Then the other term is something called the temporary difference. Temporary difference, abbreviated as TD. TD. And this now is the difference between these two values. This is the difference between tax base and the carrying amount. So if these two values are different, carrying amount and tax base are different, so we refer to that as what? As the temporary difference. So therefore, temporary difference is equal to carrying amount minus what? Minus tax base. Minus tax base. Now, in this case, we have two types of this. We have two types of temporary differences. Actually, this one should be TD. We have two types of temporary differences because after taking carrying amount minus tax base, you can get a positive figure, you can get a negative figure. A positive figure or a negative what? Or a negative figure. You can get a positive figure or a negative what? Figure. So mean that here we have two types. Two types of temporary differences. 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 Eddie is saying my board is not clear from your side. Is that the case? Is Monimus board clear from your side? Is Monimus board clear from your side? Clear from your side? Yes, I'm told it's clear. It's clear. It's clear. It's clear. It's clear. It's clear. Okay, sawa. So let's continue then. Let's continue then. So Eddie, check the internet from your side. So I've said tax base is the value of asset or liability for tax purposes. So I've said in taxation, for example, for asset, we talk of those assets which qualify for capital allowance. We talk of something known as the written down value. The written down value of an asset is the cost minus accumulated capital allowances. So the value of an asset or liability for tax purpose. Now, in this case, I've said that the temporary difference is the difference between carrying amount and tax base. And actually, in this case, I've said, how do we compute the temporary difference? We take the carrying amount minus the temporary minus the tax base. Temporary difference is equal to carrying amount minus the tax base. Basically, I've said here, if you take carrying amount minus tax base, you can either get a positive figure or a negative figure. That's why I've said we have two types of temporary differences. So which are those two types? Which are those two types of temporary differences? Two types of temporary differences. So number one, we have taxable temporary differences. And number two, we have the deductible the deductible temporary differences. Deductible temporary differences. In very simple terms, we say that the taxable temporary differences, this one, taxable temporary differences, is a temporary difference which give rise to amount, or basically which give rise to the deferred tax liability. It gives rise to deferred tax liability. And deferred tax liability, you can be able to recall in our introduction, we said these are taxes payable in the future. So therefore, the taxable temporary difference, it is amount of temporary difference which give rise to amount which will be taxable in the future, which give rise to amount which is taxable in the future. So the amount which is taxable in the future will give rise to a deferred tax liability, will give rise to taxes which are payable in the future. On the other hand, deductible temporary difference, we say, is a type of a temporary difference which give rise to amount which are allowable in the future, or in other terms, this is a temporary difference which give rise to a deferred tax asset. Is amount of a temporary difference which give rise to deferred tax asset. I hope you can be able to recall what is a deferred tax asset. In this case, I've said a deferred tax asset is a deferred tax which is recoverable by the company in the future. Is a deferred tax which is recoverable by the company in the future. So therefore, here we have said that we have two types of this temporary difference, or in other terms, a temporary difference can either be taxable temporary difference or can be deductible temporary difference. So you have said that this one, the taxable temporary difference, will give rise to amount which are taxable in the future. Give rise to amount which are taxable in the future. As a result of that, this give rise to a deferred tax liability. So a deferred tax liability, basically, you have said, is the tax payable by the company in the future. So this one, the deductible temporary difference, we have said, it will give rise to amount which are allowable in the future. It gives rise to allowable amount in the future. And therefore, this one results to something called the deferred tax asset. The deferred tax asset. The deferred tax asset. It's also important for you to note that deferred or basically a temporary difference, a taxable temporary difference arises whereby the carrying amount of the company's net asset exceed the tax base. If you're told that the carrying amount of the company's net asset is basically more than the tax base, then that gives rise to something called a taxable temporary difference. A taxable temporary difference. But on the other hand, if the carrying amount of the company's net asset is less than the tax base, then that will give rise to something called a deferred, not a deferred rather, it will give rise to something called a deductible temporary difference. A deductible temporary difference. This is what is important as far as this topic is concerned, because in most of the questions, you'll be required to determine the temporary difference. The temporary difference you have to recall is the difference between the carrying amount and the tax base. Once you have computed that temporary difference, you have to determine, is it taxable, is it deductible? Yes, that's why I'm insisting on this, that if the carrying amount is more than the tax base, that is taxable temporary difference. If this one is less than this one, that one is deductible temporary difference. Deductible temporary difference. And then you are saying we use this taxable temporary difference to determine something called a deferred tax liability. We use this one, deductible temporary difference, to compute something called the deferred tax asset. So that now, or basically from that, we can be able to proceed to the other term. Remember, you have already defined 3 terms: carrying amount, tax-based, temporary difference. The other term is something I've mentioned here, and that is the deferred tax liability. the deferred tax liability, DTL. So when talk about a deferred tax liability, this is a tax payable by the company in the future. This is tax payable in the future. Is tax payable in what? In the future. Payable in the future as a result of deferred, as a result of taxable temporary difference. As a result of taxable temporary difference. So meaning that to compute the deferred tax liability, we take this taxable temporary difference, we multiply that with the tax rate. I hope you can be able to recall what is represented by all these abbreviations. I've said that this is the deferred tax liability, which is equal to the taxable temporary difference times what? Times the tax rate. If you can't be able to remember, write that in full for you to be able to remember what each of those abbreviations represent. So therefore, the deferred tax liability, which you are saying is a tax payable in the future, is computed using that. Then we have the last term here, and that is the deferred tax asset. The deferred tax asset, we can abbreviate that as DTA, deferred tax asset. Deferred tax asset, on the other hand, this, as the name suggests, is basically a tax which the company is supposed to recover in the future. In other terms, is a tax refundable to the company by the tax authority in what? In the future. So this is a tax. A tax recoverable in the future. Is a tax recoverable in what? Recoverable in what? In the future. Is a tax recoverable in the future. Is a tax refund the company will only receive in what? In the future. Is a tax recoverable in what? In the future. Is a tax recoverable in the future. So how do we compute this deferred tax asset? The deferred tax asset, this one is computed by taking the deductible temporary difference. We multiply that with the tax rate. Deductible temporary difference, we multiply that with what? With the tax rate. So therefore, those formulas are very, very important because moving forward, you need to remember them. How do we compute the deferred tax liability? We take the taxable temporary difference times the tax rate. How do we compute the deferred tax asset? We take the deductible temporary difference times what? Times the tax rate. You also need to recall that a taxable temporary difference arises whereby the carrying amount of either an asset or liability is more than tax base. A deductible temporary differences arises whereby the carrying amount of an asset or liability is less than the tax base, So those are basically some of the terms you need to recall. And also, these are the terms you came across in financial reporting and analysis. But it's important for us to be able to remind ourselves those particular terms because they are needed for you to be able to solve any question from this topic of deferred taxes. Now, how do we compute the deferred tax? Either a deferred tax asset or the deferred tax liability. There are two approaches which can be used by the company in computation of deferred taxes. Approaches of computing deferred tax. There are two approaches, or in other terms, can we refer to them as methods? Yes. So number one, we have the income statement approach. Now, under this particular approach here, we compute the deferred tax based on something called the timing difference. So the timing difference is the difference between accounting profit and taxable profit, which give rise to deferred tax. So under this approach, we can say the deferred tax is computed using timing difference. Timing difference, which basically is the difference between accounting profit and taxable profit, and which give rise to deferred taxes. Now, this particular approach is not recommended for use by International Accounting Standard number 12. So IAS 12 does not recommend the use of this word approach here. So we can say this is not recommended for use. This approach is not recommended by IAS 12. By IAS what? 12. And this, why, if you can be able to recall whatever you did in financial reporting and analysis, FRA, in those questions for public financial statement, usually you are given carrying amount of companies and net assets and the tax base, and what you had to do is to compute the temporary difference. The temporary difference being the difference between carrying amount and what? The tax base. So this method is not recommended for use. So the other method or the other approach is called the balance sheet. The balance sheet or the statement of financial position approach. Statement of financial position approach. And under this particular method here, the deferred tax is computed using the temporary difference. We compute the deferred tax here using the temporary difference. Recall the temporary difference. This is the difference between carrying amount and tax base of the assets and liabilities. We compute the deferred tax here using the temporary difference. And actually, this is the recommended method. This is the recommended approach. The recommended approach to be used in the computation of what? Of deferred taxes. To be used in the computation